I'm using different AI like ChatGPT and Grok to assist me in my stock picking. This is a part of my YouTube public portfolio. I'll be picking a stock every week. The first step is I use Grok to pick 10 publicly traded companies that have had the most dramatic shift in public sentiment in the last year. I told it do not use any Magnificent Seven companies. These are Apple, Microsoft, Amazon, Google, Meta, Nvidia, and Tesla. These companies are so loud online that it seems to me like LLMs will find a way to include them no matter what. So for now, I'm going to ignore the Magnificent Seven. And I also wanted to focus on companies that have had a negative sentiment shift, but show signs of recovery. There's been a lot of action since COVID, where during COVID, a lot of companies got pushed up, maybe a little bit too much, and then subsequently had a big crash. And I'm thinking I can target some of those companies that are now underpriced as a result of the post-COVID crash, as we're kind of finding a new normal. So the 10 companies that pulled up are Boeing, Peloton, Rivian, Carnival Cruise, Beyond Meat, Wayfair, AMC, GameStop, DocuSign, and Bed Bath & Beyond. Now, these are all pretty good picks. However, I'm going to ask it to replace AMC, GameStop, and Bed Bath & Beyond because these are a little too meme stock for me. I kind of want to stay away from those. I'm targeting companies where I feel like I can reliably forecast their free cash flow growth. That's the main metric that I like to target. So I asked it to replace those. And then it did a good job of that, except it included this Lordstown Motors company Ride, which I could not find as a publicly traded company. So I had to replace that one too. And now my final list that I'm going to be working with is right here. Now, the next step, I don't want to spend time looking at 10 different companies. So I'm going to use ChatGPT as a way to narrow this down to 5 of the strongest companies. I said, rank the following companies in terms of financial health. Take into account liquidity, solvency, profitability, and operating efficiency. And then I asked it to specifically use stockanalysis.com for the latest quarterly reports. Because if you don't tell it what source to use, I find that sometimes it'll grab bad data. These are the 5 companies that it came up with. Now, these are the least risky. They have decent control over their debt. They're relatively profitable. They have enough cash to handle their liabilities that are coming up in the near term. So these are the 5 that I'm going to focus on. And ChatGPT does a good job of giving a why. So for Macy's, despite the challenges facing traditional retail, still generally posts consistent profits and free cash flow. It has significant brand recognition, manageable leverage. I would be surprised if I go with this one just because the retail industry seems to be falling a bit. The next step now is I'm going to go to my Excel. So I built this Excel spreadsheet to automatically crawl the web for all of the financial information that I need. Whatever company stock ticker I put in here, it's going to automatically pull up capital expenditures, cash acquisition, free cash flow, R&D, shares outstanding, shares change, revenue growth, etc. First, let's look at Macy's. Let's go in order. Macy's is slowly growing their adjusted free cash flow. So I adjust the free cash flow by research and development. I'll increase it by that figure. And sometimes I'll increase it by capital expenditures, depending on, is this company growing or are they spending money just to maintain the facilities that they currently have? If I do decide to adjust the CapEx, I will change this percentage here. Right now, I'm giving Macy's 0% for capital expenditures bonus. But anyways, their free cash flow is growing, but it's currently negative. And then their price to free cash flow ratio is also negative. So Macy's is automatically kicked out. I'm not interested in Macy's because they have a negative free cash flow over the last 5 years. Next up, Cinemark, which is CNK. Cinemark does have a nice growing free cash flow, growing at 47% average annualized increase, but starting at a very low number. I can't really take that into account too much. Cinemark does look a lot better. It's growing its free cash flow at a decent rate, and its price to free cash flow ratio is relatively at its 5-year high. So it's not cheaper in terms of the last 5 years when you compare its share price to its free cash flow. And then when I go down here, this is the revenue projections. So analysts are predicting a revenue shrinkage in 2024, 10% growth in 2025, and then 5% growth in 2026. So, okay, Cinemark's interesting. I may take that one to the next step. So let's look at Boeing next. Boeing does have increasing free cash flow. However, a big drop off in the last trailing 12 months. So that doesn't look particularly good. And their price to free cash flow ratio is also negative. It's quite a bit higher than Cinemark. So Boeing is looking a little bit rough right now. I don't know if I'll go with Boeing. Under Armour has shrinking free cash flow. That's not what I want to see. And their price to free cash flow ratio is also going down, but the shrinking free cash flow kind of makes me not very interested. So last one, DocuSign. And DocuSign, this one's actually looking perfect. So DocuSign has increasing free cash flow. It's growing at 47% year over year. here. However, it's starting very near zero. And then the price to free cash flow ratio is dropping quite a bit. This looks good to me. It's relatively on sale compared to the last 5 years when you just look at the price to free cash flow ratio. I think DocuSign is the most compelling out of these 5. So this is the one that I'm going to take to the next level, which is a free cash flow analysis. I'm going to calculate the intrinsic value using the projected free cash flow growth. So this is the spreadsheet that I built to do just that. All of the yellow cells are cells that I have to input data into. This is where I input the stock ticker, and it has a similar mechanic where it automatically scrapes the web for all of the information that I'll need to perform the discounted future free cash flow analysis. And then the graphs are built in the dashboard. So just to quickly run through this graph shows the past revenue, and then these are the analyst projections, the red being the high projection, yellow being average analyst projection, and then the green being the low prediction. So here I'm extrapolating. So the blue is the past revenue. The red line is the revenue extrapolated. So if they grow their revenue at the same pace as before, the red is what it's going to look like. And then my prediction for the revenue is in gold, and I input that revenue growth right here. So if they grow at 10%, this is what it's going to look like. Their past free cash flow margin, this is the percentage of their revenue that is free cash flow, is calculated at 20%. And their past revenue growth has been 15%. The perpetual growth rate, this is essentially inflation. The discounted future cash flow analysis takes into account the perpetual growth rate. So eventually companies are either going to get sold or they're going to just slowly grow forever. And they can't grow faster than inflation forever because eventually they would dwarf the entire US economy. So I put this assumption in here. So eventually down the road, they're going to just perpetually grow at 3%. And then the discount rate is how much I would want to discount the free cash flow for this company given their risk. This is actually a number that I look up online. Their discount rate for cost of equity is 8.38%. So that's the figure that I use. Minority stake is 0, and then I also have to input in the shares outstanding. They have 202 million shares outstanding. And then using this information, analyst high, analyst average, and analyst low price predictions, my revenue growth, and then the past projection. This is the fair share price according to the discounted free cash flow analysis. So DocuSign's current share price is sitting at $98. Now here's the big if. So here is their free cash flow margin. In the past, it has been growing. This is my prediction for their free cash flow, and this is like a continued average free cash flow. So to me, their free cash flow has been growing, their free cash flow margin, and their competitors have pretty high free cash flow margins. Like if we look at Adobe, their free cash flow margin is 35, 42, 43, 41, 36. I can safely assume that DocuSign is going to continue to slowly grow their free cash flow margin over time. So that is what I'm assuming right here. In 2025, it'll be the same, and then on average, it'll slowly increase. This is what I'm assuming the average will be going forward. If this is the case, and the analyst's high revenue prediction is correct, then their fair share price is 134. If the average prediction is correct, then their fair share price is 105. And then if the low happens, then it's not looking very good. With my assumption, I'm assuming they're going to continue to grow their revenue at 10%. I'm projecting that their fair share price is about $140 a share, somewhere between 105 and 140. Given that their current share price is 98, I think it's a good time to buy DocuSign. So this is going to be my first purchase in my YouTube public portfolio. I'm going to buy $100 worth of stock every week using AI to assist me in my purchase. So this first purchase is going to be DocuSign. It's after trading hours now, so I'm going to have to purchase this when it opens tomorrow. Next week, when I buy the second stock, I will go over the progress. So we'll see what I ended up buying DocuSign at and its current status, whether it's going up or going down. If you want to build my spreadsheet, I went over how I did it in this video right here, and I'll catch you guys next time whenever I'm buying the next stock next week with the AI assisted free cash flow analysis. See ya.